cash is king in a business, and if you don't monitor it and keep on top of it, you soon run out of money and then you run into trouble. Amortization, a bit of a difficult one to say that. Today we're going to look at some snippets from a management meeting that I have with my senior staff. So they basically sort of do zero for us. They do all the reconciliation, they do all the kind of cash flow analysis and so on, make sure that the various things are in the various categories. And then what we do on a kind of I suppose monthly basis and then quarterly is we look at the sort of profit and loss and the expenditure and debtors, all that sort of stuff from the last period. The importance of doing that is really for us to see where we're at year on year, like compares. Obviously things do go up and down. Property business is fairly stable with the kind of lettings and the block management, but things like building surveying, that goes up and down quite a lot. The handyman style part of the business, that is obviously has peaks and troughs as well, and really to try and iron that out. And debtors as well, you know, clients not paying us or buildings not having the money to pay us and all that kind of stuff. So they're really important things to look at, because cash is king in a business, and if you don't monitor it and keep on top of it, you soon run out of money and then you run into trouble. Analogy is like going along in the ocean and you can't see the rocks below until the tide goes out, and then you hit all the rocks. So if you don't look at your accounts regularly with your accounts person, then it is akin to just hoping for the best. So the EBITDA on a zero will just show you what you've made. It will strip out that cost. So it's like a kind of rose tinted glasses like version of a P&L really, because it's stripped out everything you've spent. So the idea is that you could have like a £20 million reserve fund, and you could choose to spend half of it in 1 year on research and development on new stuff, and it would make your business look like you've lost money, but actually from a profit and loss point of view, if you strip that out, you haven't lost money, because you spent more than you had, but it shows that you've taken it from your retained profit. I just wanted to do a quick exercise and just kind of explain some things around what we were doing there. So what we're doing is we're moving the firm from a kind of cash basis and sort of looking at profit and loss from a kind of very basic view, to actually really trying to shift forward to a point where we're actually looking at it really as a sort of an overview, and then obviously with certain costs stripped out and things like that. So that was one of the first sort of formal meetings that myself and Janine have had, where we're looking at all the profit and loss and all the various factors of the firms. And obviously we're not just one business, there are many different businesses. In fact, there's 14 different limited companies here. But by doing all of that, it allows us to actually look at where the pinch points are, the cash flow, when we're spending too much money on things, and really keep a really good eye on that. We're doing that monthly. I would suggest if you are a much more cash intensive business, like say if you work in the hospitality or leisure industry, if you can try and do it weekly and review what happened last week and try and make things in real fast reactions in real time, then that will suit you better. Obviously, if you're more kind of professional services, I suppose, your accountancy, surveying type firms, it might be a more clearer view if you do like a monthly thing and then do a quarterly overview of where you're at. So one of the things that I get asked a lot, what the difference is between net profit and gross profit, and although most people kind of understand it, a lot of people still get confused with it and the terminology. And I know there's quite a lot of stuff on the internet, and Richard Branson's also quite famous for saying he doesn't really understand it.
I was in a board meeting when I was about 50 years old. I think I said, is that good news or bad news? And one of the directors said, come outside, Richard, a minute. So came outside and he said, you don't know the difference between net and gross, do you? So I said, no.
You can read all about that in his books, but I thought that one of the best ways that I was taught, and I'm sure there's probably in lots of books, is about this sort of fish in the fish in the sea analysis. So you've got gross and net. So your gross profit is basically everything that's in the sea. So in the sea you might have all of the bits of rubbish, and you've got all the water and the rest of it, and that is your gross profit. It's literally everything that you do. So it's all of your turnover, everything. So if you're a builder and you I don't know, spend 10 grand on a new kitchen for Mrs. Smith, and then Mrs. Smith pays you 20 grand to fit it, then your turnover, your gross profit, is the £20,000. Your net profit is what's happened after you've actually paid for the kitchen. So that is your net profit on that job. So gross profit is 20 grand, net profit is 10 grand. But the way I always like to think of it is you've got your gross profit, which is the whole thing. And then if somebody cast like a fishing net across the whole lot and captured all of these fish in here like that, and they were literally all trapped inside there, when you then take that net out, you're left with just a net full of, I use the blue pen because that's how the fishes are. They like to be blue because they're in the sea, you see. So then you're just left with all your fishes at the bottom here, and all the rest of the stuff, all the water has gone out and you've just left with the fish. So that is your net profit. So there's your fish there, and you might have lost a few fish along the way. Obviously you can see there's more at the top here and there, and that might be because you've lost clients and things like that. So it might be your net profit across a quarter or something like that, net and gross. So that was a really good way, I think, of explaining it and visualizing it. So you've got your whole sea, everything, the whole lot, everything that you do is your gross, and then everything that you're left with is your net. So if you're a salaried person, then your gross income is before the tax man has come along and taken their little bit, and the national insurance and maybe your student loans, that sort of thing. And your net take home is down here. So that is your money that you have actually got in your bank account, which is really important because there is a difference between this and this. This is turnover. This is just money that's going through the business, and this is money that you're keeping. Your fish you keep in this net, and this, all the stuff that is captured in there falls out of the net when you pull it out of the ocean. The next thing that we were talking about was EBITDA. So I did a little explanation here of this. So basically, this is probably a more advanced terminology for a lot of businesses. And if you're that kind of maybe small to medium enterprise of around about, anywhere between 4 and 10 employees, maybe you've got someone doing your bookkeeping for you, that sort of thing. It's really important to understand what EBITDA is. So this is earnings before interest, tax, depreciation, and amortization. Bit of a difficult one to say that. We in the UK, we'd probably call that depreciation, but amortization is the word. So what does this mean? So basically, if you think about your net and your gross profit, you've got also EBITDA style profit. So this is your profit and loss, but it's your earnings before these items here. Interest, so that might be your interest on, say, like your bank loans, anything that you've borrowed credit card wise, maybe some loans, directors loans, you might be charging interest on them. Any interest payments that you're making, so they are stripped out of your earnings. So this is earnings before these items, remember. The tax that you pay to the tax man. So you might have heard on the call where I said to Janine when we were talking about EBITDA, I referenced tax, because a lot of people would say, oh, last month we actually lost money. Well, that's because we paid a £20,000 tax bill. Well, that is stripped out of EBITDA, because it doesn't mean your company's not profitable in that particular month. It means that last year they made a profit, you owed the tax man £20,000, then you've paid that at some point, but that's not in your profit and loss. It's stripped out under this EBITDA, sorry. So you've got interest, tax, depreciation. So that might be if you've bought a motor vehicle, or if you've bought some laptops or something like that, or whatever. These things are depreciation. So they might be written down over a number of years, and there's lots of guidance. Can't give you tax advice or whatever, but there's lots of things that some things you can claim for in year one, and some things you have to wait a period of time. So for example, a laptop, is written down over a 3 or 4 year period. Same with a car. You can't just claim the tax back. So you might say, I've earned £100, but I've bought a laptop at £20. I know these are small figures. I know they're a lot more before someone rinses me in the comments. But £100 and you spent £20 on a laptop, and then that laptop is only allowed to be written down over 4 years. So you only actually allow £5 a year for 4 years off of your tax bill. So your tax bill will be like you've made £95, not 80. So 100 minus 20, so you've only made £80, but you're only allowed to write off £5 of that per year. So depreciation costs, as your business grows, you might find that there are multiple avenues of depreciation. So if you buy a laptop this year, next year, and so on, there'll be ones that have started, ones that are coming to an end. So you strip out that, and amortization is when you might decide to invest some money. So for example, if you ran like a visitor attraction or a leisure centre or something like that, and you decided you were going to launch a new ball pit, or you were going to open a new water slide or something like that, or a roller coaster at a theme park, that is a one-off cost that you might pull from your reserve fund. So it might be a depreciating asset, but it is also a one-off piece of expenditure that you're stripped out. So when an investor or you are looking at your accounts, EBITDA is important because this is earnings before all of these things have happened. So basically everything here just gets crossed out. That goes into your nominal account, and then your profit and loss, your EBITDA, will go into there. And then that way you'll be looking at a true picture of the business and its performance, so that investors and outside people can understand if your business is actually profitable, if you stopped paying interest, so you paid your loans off, if the tax was changed, because obviously tax goes up and down and so on, if depreciation all finished because you bought nothing else and you didn't do any further investments. So then you can see if your business is actually profitable. Really important thing to be done. So one of the things that always makes me laugh, and a little snippet for you from about to do with EBITDA, is one of the most famous sort of mistakes of EBITDA, or laughable things in history, was WeWork, so the serviced office space people, when they wanted to IPO, so when they wanted to offer the public an initial shareholding into the company, normally this is really important, the EBITDA. So you prepare like a brochure for people to look at. There's a certain way of preparing it, and people, investors and so on, and the governing bodies that allow you to do IPOs really want to have a look at all of this EBITDA information. They decided, because there were so many odd anomalies in their accounts, Mr. Adam Newman, they decided they would do a community adjusted EBITDA, which basically didn't really make any sense to the normal world, but it was basically a whole load of things that Adam had spent on luxury items, you know, jets and various bits and bobs, stripped out of this, and they branded that community adjusted EBITDA.
Okay, a lot of people have asked about what was then called something called community adjusted EBITDA.
They're just letters. Let's use different ones. Let's reframe it. We can't let ourselves be defined by the old ways. If their letters don't fit, we come up with new ones.
We'll work off the S1 the lawyers gave us, and then we just need to subtract tenant fees and rent expenses, staffing expenses and design expenses, marketing and administrative expenses, and then we show a profit. We'll call it community adjusted EBITDA, and show them the true value of our community.
There's a good thing on Apple TV, it is actually, there's a whole thing on WeWork, so interesting. But yeah, EBITDA, really important information there, because it allows you to work out your true profitability. Unlike your gross and your net, you might find that your profit and loss is giving you this net figure here, but it's encapsulating, your gross figure will be encapsulating any of your depreciation and your various things. So gross and net, pretty important, but that's fairly 101 basic stuff. And then you've got EBITDA, which is your more advanced things. So want to get practice in that and get that on Xero or whatever accountancy software you use, and really try and drill down into those numbers.